So our table of content include the introduction of eChart Inc. and the purpose of the presentation, which is finding the relevant accounting issue, the impact on financial statement, and also the recommendation for the first investment route about acquisition. This is the privately held company specializing in customized medical software for patient record management. The user are healthcare administrator and professional. The finance investment group needs an initial review on the eChart financial record. So next is Pavitra. We talk about the revenue and the government grant.
Revenue recognition, there are some things that are at fault. Here, each chart is recording the full subscription amount right when the contract is signed, even though it covers 3 years. That's not how IFRS 15 works. Revenue should be spread over time. Also, they are grouping different services together, like training and support into one, when they should be separate. And that violates the IFRS 15 for us. That goes against it in a few areas, especially in how and when revenue should be recognized. The company also didn't separate the performance obligations, which changes when revenue should be reported. Since they recorded too much revenue upfront, the balance sheet and income statement both look stronger than they actually are. Cash flow also shows more than what's really earned during that period. They also violated the government grant option as well. The government grant required hiring 4 grads every year for 5 years, but they only did that for 3 years. They still recorded the full 500,000 in the first year, which overstates income and leaves out the liability that they may owe, which clearly violated our IAS 20. They should have only recognized grant income when conditions are met. Since they didn't meet all 5 years, they shouldn't have reported the full amount as income. And we think that they might have been violating the IAS 38 as well, which says that development costs must be capitalized only when all the 6 criteria are met, in which, in this case, we didn't think they met. And the impact it had on the financial statement is that the unearned grant inflates the statement, and they also missed capitalizing software development costs. That means their assets are too low and expenses are too high, which affects income and cash flow.
So let's talk about the account receivable. So the company stopped allocating ADA despite the dramatic growth of the receivable amount. They derecognized the full $1 million from the account receivable. The proceed, holdback, and interest expense are inconsistent and unclear. The accounting policy here, the lack of allocating allowance would exaggerate the credit risk. Factor with recourse means that the eChart retains substantially all the credit risk. Factor with recourse is considered borrowing transaction, not sale. So the impact of the account receivable, the AR became overstated while the bad debt expense became understated. Loan payable is understated due to the incorrect method of the factor with recourse, leading to the retained earning and net income overstated. For the buildings, they capitalized the construction cost for the 15-month period. There's no provision for dismantling and restoration costs. For the equipment, they recorded as a gross amount, while the discount were recorded as a contract expense. The directly attributable cost was not properly recorded. So the capitalization should end when the asset is ready for its intended use. The restoration and directly attributable costs should be estimated and capitalized at the asset cost, and the assets should be net of discount, rebate, and allowance. For the impact, the asset became overstated due to the extra capitalization and understated due to the not including the relevant cost. The liability is understated because of no provision for dismantling costs, leading to all cap expense is distorted and the retaining net income is inaccurate.
Hi, I'm Atulya Shaini. Today I'm going to talk about the financial reporting issues at HR Medical Systems, focusing on the furniture and fixtures and cerebral farm. The issues related to furniture and fixtures is that the useful life and depreciation method changed without justification, and the assets were revalued without independent valuation. Physical damages were ignored, no impairment test. The violated IFRS standards are IAS 16, evaluation and depreciation policy, IAS 36, impairment testing, IAS 8, estimation policy. This impacted the financial statements. In the balance sheet, PP is misstated, retained earnings and equity is overstated. In the income statement, depreciation was miscalculated, net income likely overstated. The issues in server farm, setup and installation costs were wrongly expensed in 2018. No impairment recorded in 2021. The violated IFRS standards are IAS 16, capitalization rules, IAS 36, impairment testing. This impacted the financial statements. In the balance sheet, PP and retained earnings were overstated. In the income statement, no impairment loss was recorded. Net income is possibly overstated. And in the statement of cash flow, the investment activities are understated and the operating activities are overstated. So that's all about my topic. Thank you.
I'll be talking about the company's recent investment decision and accounting issue related to IFRS 9. From the slide, you can see that they invested their extra cash in Tesla and IBM shares and also in national bank bonds. But these investments were recorded at their original purchase cost without updating their face value. This completely goes against IFRS 9, but IFRS 9 requires these investments to be shown at their fair value. Since each chart didn't do that, its financial statement might not show the correct values. From this slide, you can see that instead of paying off low-cost debt, each chart invests the extra cash. This can increase the return, but also they are adding more risk into their business. And also, this may mislead about the company's liquidity. These are the three issues they'll be gonna face in the future if they are not gonna follow IFRS 9.
Finally, I will report our group's conclusion. While the company follows some accounting rules, each article system is not correctly recording everything, leading to major errors in the assessment of revenue, government grants, and receivables. These revenues errors will eventually affect the reporting of profits and leading to misleading numbers in the market. And for the finance investment group, they need to do a thorough check on eChart's records because eChart has been recording everything wrong, so they might not be as profitable as they think. And I would recommend to not invest in eChart unless they fix their numbers and then give a final report after fixing everything. And that should be everything from our group. Thank you.